What is an FHA mortgage? What does FHA even stand for? Why would I use an FHA mortgage? Hi, I'm Amy Shrader with RE/MAX Real Estate 10. Welcome back to the Shrader Show, where today we're going to talk about FHA mortgages, and I'm going to share with you some facts that you may not know about FHA. Now, to start with, FHA stands for Federal Housing Administration. All right. It is a government program that is designed to help people get into homes with little to no money down. So typically an FHA loan is going to require a 3.5% down payment. Now, there are some programs that are available that would actually gift you that money through a grant for your down payment. That would help with the down payment. It would help a little bit with your closing cost. You could get a gift from a family member or an employer to help you cover that 3.5%. Okay, so while it's not 100% mortgage, it is a low down payment option that is available to help people get into homes without a huge down payment. Now, one fact that you may not know about FHA is that you can qualify for an FHA mortgage after only 2 years out of a bankruptcy and 3 years out of a foreclosure. Okay, so if you're thinking, well, there's no way I'm going to get one of those first-time buyer loans because I had a bankruptcy a few years ago and I lost my house in it. That's not the case, okay? They do understand that people have instances that happen in life that are usually isolated and it will affect your credit. So if you're 2 years out of bankruptcy, and that's from the discharge of your bankruptcy, or you're 3 years past the date of foreclosure, then you could qualify for an FHA mortgage, okay? You can get an FHA mortgage with a credit score as low as 580. Now, some lenders do have what they call a credit overlay, and they will have a higher credit score requirement. But the FHA requirement in general is 580 or above, okay? So again, you don't have to have perfect credit to qualify for an FHA mortgage. FHA loans are going to hold a little lower interest rate than a typical conventional mortgage because, again, they're trying to help people get into homes with little to no money down. So your interest rate could be a little bit better than it would be on a conventional mortgage. FHA is not going to be for everyone, though, because it's not going to work for an investment property. It's not going to work for a second home. It's not going to work on a higher end property. Now, you can buy a duplex with an FHA mortgage, but you have to intend to live on one side of the duplex and rent the other out. So duplexes are allowed, but primarily FHA is going to be used for single family residences. All right. Another fact that you may not know is that FHA is kind on debt limits, but it is very tough on deferred student loans. Okay. So, a lot of the times you will hear that you need to have a 28-35% ratio, 28% on your housing, 35% total debt. FHA will actually approve people with up to a 50% debt ratio. Now, I don't know that that's always a great thing, but if you have, a cash side job or something that allows you to make those payments, but you can't prove that income, then FHA may be a great option because it will allow you to go up to a 50% debt to income ratio, okay? But if you have student loans and you are paying those late, or if you have an incredible load of student loans that are deferred right now, they are going to be hard on those. So you'll have to take that into consideration as well. If you have a good credit score, you'll probably end up paying more with FHA's mortgage insurance than you would through a conventional loan, okay? Conventional loan, obviously, the higher the credit score, then the lower your private mortgage insurance would be. On FHA, it's kind of across the board. This is the rate, all right? And it is going to be higher because, take into account, they're doing people with credit scores down to 580 and maybe DTIs, debt to income ratios, up to 50%. So the risk is greater to them, and the private mortgage insurance is going to be a little bit higher. One disadvantage of an FHA mortgage is that the mortgage insurance is going to stay on that payment through the life of the loan. As long as you have that FHA mortgage, you will have the private mortgage insurance payment. Okay. On a conventional loan, when you reach about 78% loan to value on your principal balance, they will automatically take that private mortgage insurance off of your payment. FHA does not do that. So, FHA is a great way to get into the house. And then as you start making payments and you start building equity, you may want to look at refinancing into a conventional mortgage so that you won't have that private mortgage insurance. Okay. That was an option that I used myself. I bought my house in 2017 and I used an FHA mortgage to purchase it. And then actually in 2019, because rates had dropped and I had been making extra payments on my mortgage, I refinanced into a 15-year conventional fixed, and my payment really didn't change that much because I was paying almost, I think, $95 a month in mortgage insurance. So now that money was actually going to the principal and interest payment. All right. So there's some facts you may not have known about the FHA program. It might be the best deal for you. It might not. It would just depend on your situation. If you have questions about FHA or buying a home in general, feel free to reach out and let me know. I'd be glad to help answer your questions. Or if you have a question you'd like to see featured in a future episode of the Shrader Show, please leave me a comment, send me a message. I would love to answer your question. Be sure to hit the subscribe button below and then ring the bell so that you'll be notified of future videos. Thanks so much for watching. I look forward to seeing you again.